Today, Chris Lapine will share best practices for association accounting. He'll show some examples of standard accounting reports and discuss some of the unique facets of nonprofit accounting. Chris Lapine is an association manager at Allen Press. He provides business management services and governing council assistance for multiple nonprofit scientific and academic societies and works closely with the Allen Press Accounting Department to ensure that his clients have an understanding of nonprofit accounting principles and best practices. He joined Allen Press in the spring of 2014. Chris graduated from the University of Kansas with a BFA, and he enjoys spending time with his 3 daughters, traveling the world, and of course, formulating contingency plans for the impending zombie apocalypse. I'm going to go ahead and turn over the presentation to Chris so he can get us started.
Good morning, everyone. Thank you for the introduction, Joanna. And thanks again for joining us today in this entry in the Allen Press Best Practices and Innovative Solutions webinar series. This month's webinar will cover best practices for association accounting. As you all know, volunteers can make or break an association, and the hardest position to fill for many associations is that of treasurer or finance committee chair. Even individuals with financial experience are often daunted by the mysteries of nonprofit accounting. Don't worry, we're here to help. In this webinar, we'll share best practices for maintaining your association's chart of accounts, how to understand commonly used financial reports, and managing donated funds to their intended purposes. We'll also discuss important IRS forms that every association should file. The first thing we'll cover is how does nonprofit accounting differ from for-profit accounting. Anyone familiar with generally accepted accounting principles and practices will find most accounting for nonprofit activity to be very familiar. There are, however, some differences, including differing business intent and multiple methods for revenue and expense recognition. First, let's take a brief look at the descriptions of the most common financial statements used in most every form of accounting methodology. While the purpose of these reports is the same, nonprofit and for-profit entities will call them different things. In the nonprofit world, the statement of financial position, statement of activity, and statement of cash flow are utilized to record assets, liabilities, net assets, revenues and expenses, and cash disbursements. Whereas on the for-profit side, these reports are known as a balance sheet, income statement, and cash flow statement. We will be digging into these 3 important reports later in the webinar. Please remember that if you have any questions, use the chat function of WebEx to direct questions to us during the presentation, and we'll be answering them after the webinar. Understanding the intended business purpose of your association is crucial in maintaining the proper course and strategy as dictated in your association's charter, constitution, and bylaws. Here we have the main goals of nonprofit and for-profit organizations. The financial goal of most nonprofit organizations is to meet their budget, whereas the financial goal of most for-profit organizations is to generate as much capital as possible. Moving beyond your association's business intent, the next differing factor between accounting for nonprofit and for-profit associations is deciding on what recognition method will be utilized. The accrual method and the cash method, sometimes called accrual basis and cash basis, are the 2 principal methods of keeping track of revenue and expenses, and it is important to understand the difference between them. The difference lies in the timing of when revenues and expenses are recorded to your accounts. We will now look at these 2 methods more closely. Under the accrual method, revenues and expenses are recorded when they are earned, regardless of when the money is actually received or paid. This method is more commonly used than the cash method. The benefit is that the accrual basis gives a more realistic idea of income and expenses during a period of time, therefore providing a long-term picture of the association's finances that cash accounting cannot provide. A common misconception is that it is not as obvious to see cash flows with accrual accounting. An entity can appear to be very profitable when in reality it may have an empty bank account, but by examining the statement of cash flow, you will have full visibility to the financial health of your association. We will talk about the statement of cash flow more in depth later in the webinar. The accrual method of accounting should be used by organizations starting out with larger amounts of funding, paid staff, and plans to raise additional funds from larger donors such as foundations or government entities. Generally accepted accounting principles also require the use of accrual method, and this method is utilized by Allen Press for all of our accounting clients. Additionally, if you wish to have an audit done under generally accepted accounting principles, you should always use the accrual method of accounting. Accrual-based accounting without careful monitoring of the statement of cash flows can have potentially devastating consequences. So if you are not currently receiving the statement of cash flow from your accountant, we recommend that you ask them to provide it to you on a monthly basis along with your association's other financial statements. It is important to note that the IRS suggests nonprofits use the accrual method, and if the cash method is used, additional reporting is required. The cash method recognizes cash when it is received and expenses when they are paid. This method does not recognize accounts receivable or accounts payable. Smaller associations with very few transactions and individuals opt to use the cash basis of accounting because it is simple to maintain, but it is not recommended by the IRS and is not forward-looking enough for due diligence. The cash method of accounting may seem to be the easiest method, but it is not necessarily the most accurate. Always be sure to check your state's regulations. Some states require the accrual method of accounting to be used. Now that we've covered the different accounting recognition methods at your association's disposal, we will talk about the financial statements we touched on briefly at the beginning of the webinar. The statement of financial position, the statement of activity, and the statement of cash flows, along with the new concept, the chart of accounts. At this point, you may be asking yourself, but Chris, what is a chart of accounts? Have no fear, friends. We have an answer. And if you have questions, make sure to send them our way. A chart of accounts, or COA, is a financial organizational tool that provides a complete listing of every account in an accounting system and is used to organize the finances of the entity and to segregate assets, liabilities, revenue, expenses, and equity in order to give interested parties a better understanding of the financial health of the entity and association. It is very important that you utilize the chart of accounts properly, as it will ensure that all expenses, revenues, assets, and liabilities are recorded in a way that will result in a better understanding of your other financial reports. The chart of account is your friend as it organizes your finances so that reports make more sense. It creates an organized system to read the financial reports while centralizing information and ultimately making things easier to decipher. Providing the chart of accounts to your board members will help them understand your other financial reports much more clearly. Let's take a look at a sample chart of accounts and how it's structured. Accounts are typically defined by an identifier or an account number, and a caption or header that are coded by account type. In some countries, charts of accounts are defined by the accountant from a standard general layout or is regulated by law. However, in most countries, it is entirely up to each accountant to design the chart of accounts. It's very important to establish the structure of your chart of accounts in a way that fits your association's business intent. These are the categories we use at Allen Press. They are also commonly used by accounting firms, but there may be some variation from association to association. You'll see these numbers later on as well. For example, assets are listed under the 1000 series, liabilities under the 2000 series, net assets the 3000 series. Revenues are under a range of the 4000 to 5000 series, and all expenses are listed under the 6000 to 8000 series. Now that we have covered some of the reports and methodologies involved with nonprofit accounting, let's touch on the best practices that will help your association's treasurer, finance committee members, and board members to better understand these approaches. Remember that financial statements are summaries and that details are the responsibility of the accountant and/or treasurer. Your board members typically need only to view the summaries, and details can always be provided upon request. Additionally, financial statements should be kept to 1 to 2 pages to keep things simple, and accounts should be organized according to revenue streams, such as membership, publications, meetings, and other. Your expenses should be organized in a very similar way. We will now discuss additional statements and concepts that will assist you in mastering your association's finances. The biggest value in financial statements is comparability. The reason you have all of these different periods is so that you can compare current performance to prior performance. Earlier, we spoke about the statement of position, statement of activity, and statement of cash flow, and that they are utilized to record assets, liabilities, net assets, revenues, expenses, and cash disbursements. The statement of position includes data for the current year and prior year. The statement of activity will show the current month, current year-to-date, prior year-to-date, and your association's budget. The statement of cash flow contains data for the current month and the year-to-date. Now, let's take a look at some examples of these statements. Here we have a sample of a statement of financial position. This report, also known as the balance sheet, is one of the main financial statements, and it reports an entity's assets, liabilities, and the difference in their totals. You will notice that it includes the accounting categories from the chart of accounts along with data for the current year and the prior year. The net assets section of a nonprofit statement of financial position reports totals for each of the following classifications: unrestricted net assets, temporarily restricted net assets, and permanently restricted net assets. For the portion of these that come from donated funds, these classifications are based on restrictions made by the donors at the time of their contributions. If a donor does not specify a restriction on his or her contribution, the amount received by the nonprofit is recorded as an asset and as an unrestricted contribution revenue. If a nonprofit receives a contribution that has a donor-imposed restriction, the amount is usually recorded as an asset and as a temporarily restricted contribution revenue. If a donor stipulates that the contribution must be held by the nonprofit in perpetuity, the amount is recorded as an asset and as a permanently restricted contribution revenue. Put simply, a nonprofit statement of financial position is represented by a very easy accounting equation. Assets equal liabilities plus net assets. Here we have a statement of activity. This focuses on the total organization as opposed to focusing on funds within the organization. It includes data for the current month, the current year-to-date, prior year-to-date, your association's budget, and again, the accounting categories that we spoke of before that come from your chart of accounts. The statement of activity reports the following items: revenues, such as contributions, program fees, membership dues, and grants; investment income, and amounts released from restrictions; and of course, expenses. Here we have the statement of cash flows. In financial accounting, a cash flow statement, also known as a statement of cash flows, is a financial tool that shows how changes in balance sheet accounts and income affect cash and cash equivalents. It also breaks down the analysis to operating, investing, financing activities, along with a summary of your association's cash account balances. As mentioned previously, this is the report you will want to make sure your accountant is providing to you on a monthly basis along with your other financial statements. Another important facet to your association's financial health are donations. Nearly all nonprofit associations rely on donations from their members to help bolster the bottom line and assist with many of the programs and initiatives set forth by the governing body. It is important to remember that donation funds are restricted to the stated purpose of the fund, which is chosen by the donor from those accepted by the organization, and that these are explicitly recorded at the time of donation in your association's bylaws. Once you establish the purpose of a donation fund, you will be beholden to stay within those terms as they are unchangeable. We recommend that you create a small number of designated funds and one unrestricted fund. Examples of donation accounts may include a base unrestricted fund for multi-purpose use, and funds for grants or research awards, scholarships, meeting travel awards, and a variety of other association-specific accounts based on the need and structure of your organization. It is imperative that you clearly define the purpose and requirements of your association's donation accounts. Key questions that must be addressed would be, for what purpose will the funds be distributed? Is there an annual threshold for spending? And will both principal and interest be utilized? And is this defined in your bylaws? We appreciate your participation today and hope that the items covered in this presentation have given you some insight into the best practices for association accounting. Let's continue by looking at how various association activities will show up on your financial reports. Membership and subscription revenue, along with meeting registration and donations, is a key silo in your association's revenue stream, and understanding how these appear on your financial statements is very important. Subscriptions, which are often tied to membership, will appear as revenue on the statement of activity. Memberships and subscriptions will also appear on the statement of position as part of a bank account asset, as well as part of a deferred liability when using the accrual method of accounting, which again is always recommended above the cash method. Annual meeting registrations will appear as revenue on your statement of activity and will also appear on the statement of position as part of a bank account asset, as well as part of a deferred liability. Finally, donations will appear as revenue on the statement of activity and will also appear on the statement of position as part of an asset as well as a restricted net asset. Now I call this part happy fun time, because the final topics we will touch upon are a few of the IRS forms that you will need to familiarize yourself with. Again, please make sure that you direct any questions to us, and we'll be happy to answer them. First, the IRS Form 990 is an annual reporting return specific to tax-exempt organizations that must be filed with the IRS. It provides summary financial information, officer and employee listings, and an indication of governance policies. An IRS Form 1099 is a type of information return, and the association is responsible for distributing these to all payees who receive $600 or more for awards and services in the reporting year. Expense reimbursement is not included in this amount so long as receipts are collected for the expenses that total or exceed the $600 limit. For example, if an individual received a $500 travel grant and was then awarded $400 for a winning abstract, the total is $900. And receipts would need to be collected for the $500 in travel expenses in order for the total of $900 to not be recorded as income and be taxable for the payee. If receipts are not collected, it is required by law that the payee receive a 1099 from the association. The association is also responsible for requesting a completed W-9 form, which is known as a Request for Taxpayer Identification Number and Certification from all payees. We highly recommend that you think about the amounts that you set up for grants and awards to minimize the number of 1099 forms you have to distribute and to minimize the tax impact on the individual. To wrap up, remember that the accrual method differs from the cash method, with the key benefit being the accrual method's objective to match revenues and expenses. Keep the financial statements and reports to the board simple and focus on distributing funds to the correct payee and always requiring a W-9 at the time funds are distributed. An example of this would be, do you give the editorial stipend to the editor as an individual, or do you give it to their institution? Since the tax laws pertaining non-profit associations are changing all the time, it is imperative that you are making the payments to the correct entity. Thank you again for joining us for today's webinar, and we will now answer any questions that you might have.
Chris. We do have one question so far, and that is regarding audits. What's the recommendation for having audits done? Do small organizations need to spend money on this type of activity and have someone conduct an audit for them? Maybe how often would that be done, et cetera?
Yeah, we would recommend that audits be done every 2 to 3 years. Regarding spending money on audits, of course, that is an expenditure that your organization would have to pay out for an audit. Yeah, in order to, you would have to pay for the review, but yeah, you'd have to pay for the review, of course, and a review is cheaper than an audit. So deciding on whether you want to do a review or an audit would be up to your individual organization.
Great. We'll wait just a minute to see if there are any other questions. You can use the chat function of WebEx to send those in, and up in the top right-hand corner, you should have a blue chat bubble. If you haven't opened up your chat window yet, that would be where you could start to send in a question. So I think as a follow-up to the last question, someone wanted to know what really is the difference between a review and an audit?
A review is a much more simpler, smaller overview of your organization's finances, whereas an audit is a very in-depth procedure. Here at Allen Press, we have an accounting firm that we deal with as well that helps us handle audits. Those can take, the audit process can take 6 weeks. It's very in-depth. Again, the review is much more simpler. The price of a review is typically about a third of what an audit would be.
Okay, great. Another question regarding international societies. What determines whether an international association is subject to U.S. tax laws?
Yeah, that's a great question. The key factor there is whether or not your association is incorporated in the United States. If you are, then you are subject to U.S. law.
Great, and as kind of a follow-up to that, even U.S. companies sometimes deal with international individuals, and when we were talking about, the kind of tax forms that you have to collect for individuals, how do you deal with that when the individual, that you paid out to or whatnot is not a U.S.
Sure, yeah. Very simply put, if the payee has a Social Security number, then they are subject to receiving and turning in those IRS forms. You don't necessarily have to be a U.S. citizen, of course, to have a Social Security number. So if you're dealing with students who have temporary visas, work visas to be in the United States, they'll be given a Social Security number. So it's very important that those folks that have those, that your association is following the tax laws pertaining to that issue.
Great, thanks, Chris. Well, it looks like that's all the questions that we have